Good evening, my fellow investors and traders. Today is February 1st, approximately 8 p.m. Eastern Standard Time. Here in the U.S., it was a very important day as the Fed had another press conference after their most recent rate hike. As expected by most of the market, the rate increase was 25 basis points. And the market responded very nicely to that. The Fed continues to talk rather aggressively, meaning that they intend, or at least they're showing us an intention of being consistent with these rate hikes going forward. And that could be the case, and it might not be the case. I tend to believe that at some point here in the spring of 2023, going into early summer, we will experience a pause. And as I've reviewed in my last videos, the primary indicators that are showing me that are the U.S. 10-year Treasury and the U.S. 2-year Treasury. It looks like they may be calling the Fed's bluff on this, all right? But is that the case? Another very important chart, which I've referenced often in my videos, is this housing market chart. Now, I don't often pull it up in my videos, rather I speak to it and reference it. Several of my viewers have requested that I revisit the chart and just explain what's going on. I will post a link to this chart in my video if you want to study it further. I reference it often because I think it's very important, and outside of that, I think it is data that the Fed is most definitely looking at. The U.S. housing market, or the real estate market here in the U.S., is one of the last economic strongholds that unfortunately we have. We've outsourced all of our manufacturing. We've outsourced a lot of our labor. And due to the impact of that, we don't have much to cling to other than our real estate market. So if the real estate market crashes here in the U.S., it spells a very dire macroeconomic picture for us. And therefore, I believe that the Fed looks closely at this data. Now, as I've stated many times in the past, the Fed is mostly reactionary. And so if history is any indicator of what the Fed will do, then once again, I see the Fed reacting or responding to specific data that they consider critical for their future decisions going forward. That being said, let's just jump into this chart, and I'll review here once again what I have noted as important on this chart. First of all, you can see I have the Dow Jones Industrial Average outlined in purple. That's this purple line, of course, that goes way up here. I've got the federal rates in black, denoted in black, and the housing market is indicated by green or red. If it's below this, what I call weakening demand zone, this threshold, it turns red. Above it, it's a bull market. All right, so let's review what happened in past history, specifically 2006, which started in the Detroit metro area here in the U.S. What happened is nationwide, there was a lack of demand for new cars, new automobiles. All right. This lack of demand led the big three automakers to want to cut costs. Of course, when cutting costs, one of the largest costs is labor. So laying off employees caused people in the Detroit metro not to be able to pay their rent, not to be able to pay their house bills, their house loans, and they had to either sell or find a new job, which was hard to do in the Detroit metro area to pay their house loans. Therefore, the housing market began to crash here in the U.S. in the Detroit metro area first, and had a ripple effect across the U.S. economy. All right, so you can see that's indicated by this big red arrow pointing to the juncture at which we cross below this weakening demand zone threshold. All right, and that is also denoted by this vertical line, which crosses another red line that I have down here on the RSI. Same thing. Once we get below this red line, once we get below this red area here, it spells trouble for the housing market. All right. So first noticed in the Detroit metro area. Fast forward to today, we've crossed that in September of last year. We have now been below this weakening demand zone, this threshold, for a period of 5 months. And we notice weakness in housing markets like Phoenix and Las Vegas and Austin. I suppose you could throw San Diego up there and some others as well. Those cities first told us that the housing market was softening. And you can see it's almost so far an exact repeat of 2006. 2006, we started to crash in the housing market. Then we had a classic bear flag. Housing market started to come back again, looked like it was going to start to do well again, and then crashed. All right. Will that same scenario play out today? So far, it is. All right. So we came down here. Looks like we're forming some sort of a bull flag. I don't think this is going to be a V-shaped recovery. Certainly, consumer sentiment is not directed that way. Everybody is predicting recession. So is this going to be another classic bear flag here for the housing market? It remains to be seen. But so far, we are on repeat, folks. And that is very important to note. All right. With that being said, let's take a look at what the Fed was doing once we crossed below this threshold of weakening demand in the housing market. You can see the Fed back here in 2006 was still in the process of raising rates. And it wasn't for a full 2 months after we crossed over that threshold, that vertical line there, that the Fed only then began to pause. They then paused for a full 12 months before they pivoted and began to do quantitative easing. So it was full 14 months after crossing below this weakening demand zone that the Fed finally pivoted and started doing quantitative easing again versus quantitative tightening. All right. Well, before I get there, so what's happening thus far? Again, same story. Same exact story. While the housing market is declining and forming what looks to be a classic bear flag, the Fed is still in the process of tightening. We are now at 4.35, somewhere around there. Our interest rates, and the Fed is not indicating that they are going to pause. In fact, they're staying true to form and indicating that they will remain consistent with rate hikes. Is that going to be the case or is it not? That's the big debate. That's the discrepancy, I guess you could say, between what the U.S. 10-year and 2-year is telling us and what the Fed is articulating in their language and press conferences and speech, so on and so forth. All right. So we continue to see the Fed tightening, and all while the housing market is growing weaker and weaker. Now, I will say this spring through midsummer of 2023, I do expect the housing market will do very well. In fact, I think down here, we will cross back above this red line, end up somewhere up here before coming back down, just like we did over here in 2007. We crossed back above this red line before coming back down. So I think that's very plausible and maybe even probable. And up here, I think we continue up. Maybe we even continue all the way up to the underside of this weakening demand zone before we continue down again. I think the housing market will do that well in the spring to midsummer of this year. And everybody is going to think everything's all good again. No worries. No talk of recession. Recession is over. That's going to be the talking points on CNBC, specifically Jim Cramer, who is the uber contrarian indicator. You start to hear him talking about a bull run again, and this is a bull market again. There's no weakness in the housing market, etc., etc. Then be very aware that we are nearing a turning point to the downside once again. Basically, you can take what he says and do the opposite, and you'll be just fine. Just fine. All right, so now let's talk about what the stock market was doing during this whole time. All right, so while the housing market was experiencing severe weakness and a crash, look at what the Dow is doing. Look at this. It was not 17 months after we crossed below this weakening demand zone in the housing market that the stock market, specifically the Dow Jones Industrial Average, topped. All right, so we topped right here. I'm going to mark that out here with V. Let me just decrease the width of that line so it's not so severe, just so you can kind of see where we're at. So it was almost near the next bear flag here in the housing market. All right, almost the bottom of that next pivot point or next wave before the Dow Jones Industrial Average topped. And look at this. Once we topped and started to head down, that is when the Fed started to react and do their quantitative easing. This, again, supports the thesis that I have been alluding to so often in my videos regarding a blow-off top coming to a exchange near you this summer. All right, I believe that the markets, the stock markets specifically, will exceed the previous high that was set in November of 2021. And I mainly chart the S&P 500. I think it gives us the most accurate data. I won't say most accurate. That's not even the right terminology. It's just what I tend to track above Dow Jones and the other markets, because it seems to well, I don't even need to get into why. It's just what I track, and I think that we see the S&P go to 5,000, possibly 5,500, maybe even 6,000 before we finally hit our top. That would make sense in terms of timing. All right, so it was a full 17 months before we crossed below this threshold. How am I doing on time here? All right, I have to be cognizant of this for TradingView people. All right, so far it's been 5 months, and we are still heading higher in the markets. All right, we haven't matched or rivaled our November 2021 high yet, but you can see from previous videos I've shown that we are in breakout form right now. We have broken several major macro downtrend lines and uptrend lines on the US 500, which is the index that I have been charting. All right. So what does all this mean? I think most importantly, what I'm getting at here is it appears so far every indicator I have on this chart is repeating exactly what we saw during the 2006 to 2009 housing market recession / bear market or crash. Okay, so that period lasted for 3 years, and I don't have any reason to believe that anything is different about this time around. We have extremely bearish consumer sentiment. We have inflation that the Fed is battling. We have horrific geopolitical situations taking place throughout the world. Ukraine, Russia, or should I say US, Russia, Taiwan, as China is threatening to invade Taiwan. We have just absolutely abhorrent leadership in every way, shape, and form. We have misinformation like never before. All of this, guys, I mentioned this because this is what affects consumer sentiment. All is not well in the U.S. We have an extremely sick society, and by sick I mean weak, dying society. The system is failing a good many people, and it doesn't seem like we can get it right. It doesn't seem like we can make it healthy again. That plays into consumer sentiment. I have no reason to believe that the housing market is just going to magically be bullish again. It makes no logical or reasonable sense to me, right? But all that being said, that does not mean we won't have a good spring to midsummer here in the housing market. That does not mean the stock markets will not follow that extremely bullish housing market here into the spring, midsummer. And that does not mean we won't have this blow off top that I keep alluding to. I think all of those things will be true. Good housing market, good stock markets, blow off top, beating previous highs. Crypto will follow that. And then the thing that I don't want to mention, the big D word, hits us. And we've never experienced anything like what I am seeing on the charts, and I hope to God that I'm wrong about all of this. I've been wrong before, so pray that I'm wrong again. But it does not look good unless something seriously changes here in the U.S. So that's what I'm seeing, guys, and this data is important because history often indicates what happens in the past. We don't tend to learn from history. We tend to just repeat it. And so if you know this, you can use this knowledge to your advantage. And that's what I'm trying to help you all do. I'm trying to help you trade this in a way that you can take advantage of this near or this midterm blow off top, which should take us to our previous highs or higher, exceeding them. Profit, and then get yourself ready for what's to come. All right, I'm closing in on 20 minutes here, so I've got to say goodbye. If you've appreciated this video, this information, this knowledge, and this data in any way, shape, or form, please let me know in the comments or give me a like. And I will talk to you all in the next video. Peace.